Welcome, my friends. Don't look now, but Amazon lost half its value this year. This comes as most tech stocks got crushed. And basically, everyone is predicting a recession. Shares of Amazon set to finish their worst year since 2000. And their second worst year ever. Amazon stock has fallen 51% this year. Basically, hundreds of billions of dollars in market capitalization have evaporated. But Amazon still performed better than Meta and Tesla in 2022. If you follow this channel, you know that I already posted a video about layoffs at Amazon. Amazon is actually laying off 20,000 employees. What does it mean for Amazon? What does it mean for big tech companies? What does it mean for the economy? And, what does it mean for the future of the United States? But, before we get into all of that, please press the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Shares of Amazon lost half of their value in 2022. As you probably know, tech stocks got crushed and recession fears grew. It was a brutal year for mega-cap tech stocks across the board. 2022 was a rough year for Amazon. Shares of Amazon are having their worst year since the dot-com crash. The stock has tumbled 51% in 2022. That is its largest decline since 2000 when it plunged 80%. Only Tesla, which is down 68%, and Meta, which is down 66%, have had a worse year among the most valuable tech companies. Amazon's market cap has crashed to around $834 billion. That is from a lofty $1.7 trillion to start the year. Amazon fell out of the trillion-dollar club in November. Of course, Amazon is blaming a weak macroeconomic environment. As you know, inflation is soaring and interest rates are being raised to fight inflation. Higher interest rates have pushed investors to fixed interest investments. And also, into companies with high profit margins, consistent cash flow and high dividend yields. And away from growth-oriented tech stocks. But Amazon shareholders have had a number of reasons to sell the stock. The company is experiencing slowing sales. And a sustained post-COVID e-commerce boom didn't pan out. Amazon blossomed at the height of the pandemic. Consumers actually relied on online retailers like Amazon for the necessities of life. Toilet paper, face masks, and even patio furniture. Shares of Amazon stock rose to record highs as sales soared. But when the economy reopened, shoppers returned to stores. Consumers also went back to spending on things like travel and restaurants. This spending migration caused Amazon's impressive revenue growth to fade. Then, things got worse in January. The online retail giant confronted higher costs, inflation, the war in Ukraine, and supply chain constraints. Amazon CEO Andy Jassy succeeded founder Jeff Bezos in July 2021. Jassy admitted that Amazon basically hired too many workers. It also seriously overbuilt its warehouse network. During the pandemic, Amazon raced to keep up with demand. But since then, growth has slowed and Amazon abandoned plans to open new warehouses. Amazon also cut headcount in Q2. Jassy has also started an in-depth review of the Amazon's expenses. Some programs have been cut, like the whole robotics team. There is a hiring freeze across its corporate workforce. Amazon is also set to lay off 20,000 employees. Even Amazon's cloud computing segment is not immune from economic headwinds. Oz experienced its weakest revenue growth to date in the third quarter. Wall Street analysts have reduced their estimates for Amazon for a number of reasons. Weakening macroeconomic conditions, softness in online retail, and weakness in cloud computing. For example, Evercore ISI analyst Mark Mahaney cut his 2023 estimates for Amazon. Mahaney is now predicting total retail sales growth for the year of 6%. That is down from 10%. Mahaney also cut his estimate for Amazon Web Services revenue growth to 20% from 26%. Still, Mahaney said he remains bullish on Amazon's long-term prospects. He called Amazon stock a buffet buy because of its assortment of many businesses. Mahaney pointed to Amazon's growing market share in key areas: online retail, cloud computing, advertising, and its apparent insulation from risks such as ad privacy changes. Amazon is also making strategic investments in new areas: groceries, healthcare, and logistics. For those investors who utilize 2 to 3 year time horizons and are looking to take advantage of the recent dislocation in high-quality net stocks, we highly recommend AMZN, wrote Mahaney. Recessionary concerns or real and earnings estimate will have to come down, Mahaney continued. Amazon remains arguably the highest quality asset we cover in terms of revenue and profit outlooks, Mahaney also wrote. Mahaney has an outperform rating on Amazon stock. Like a lot of technology companies, Amazon went on a hiring spree during the pandemic. Now, the company needs to retrench. The pandemic forced most people to work and play games at home. That drove the accelerated need for laptops and online subscriptions. It also prompted the federal government to stimulate the economy. Now, effects are being mostly undone. Jassy said that layoffs would affect the devices and books businesses. The people, experience, and technology organization will also be impacted. Amazon is also extending a voluntary reduction offer for some employees. Actually, enterprise technology spending is still expected to grow over the next year. But, despite that forecast, technology companies are wary of demand. And that is particularly true of technology companies with big consumer retail businesses. A lot of factors are having a negative impact on demand. Rising interest rates, the war in Ukraine, high fuel costs, supply chain issues, and a decline in personal computer sales. If you follow this channel, you already know that many tech giants have announced layoffs in the past few months. Even growth at Amazon Web Services, AWS, has been slowing. And AWS is Amazon's most profitable business and cloud services division. For the past 3 quarters, AWS revenue year-over-year growth slowed. 36.5% in Q1, 33% in Q2, 27.5% in Q3. And who did Amazon blame? You guessed it, the usual inanimate whipping boy, weakening macroeconomic conditions. If you follow this channel, you already know the economic narrative of the times. Inflation is raging in most countries around the world. Central banks around the globe are aggressively raising interest rates. Consumers are feeling less confident. And they are cutting back on discretionary spending. Amazon has actually cut warehouse space. In fact, Amazon has also canceled new warehouses that were on the drawing board. It has cut some experimental projects, like robots. And Amazon closed its telehealth service. New Amazon CEO Andy Jassy is showing that he is a very different CEO than previous CEO Jeff Bezos. Of course, Jassy ascended to the CEO position at a different day and age with different economic realities. Amazon has 1.54 million employees worldwide. But, most of those employees are warehouse workers. And that is after Amazon actually cut its workforce for the first time in years in Q2. About 75,000 of Amazon's employees are in the Seattle area. That includes corporate office employees. Amazon also has corporate employee bases in a number of other cities across the United States. Virginia, Tennessee, Silicon Valley, and New York. So it looks as though Amazon's new CEO is really tightening the ship. And the future Amazon is not the Amazon of the past. We could be seeing the maturation of Amazon. But, what do you think? Please leave us a comment below and hit the like button. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Please share this video on social media. Thank you for watching.